Welcome to today's class on saving and investing for your future, fourth in a series of 6 classes on financial literacy. I'm Tom Carlton, and I've been instructing classes with adults for over 5 years at WorkSource, mainly revolving around job search and workplace soft skills like conflict management, teamwork, personal workplace accountability, communications, with a little bit on personal finances. Now, this presentation today is mainly drawn almost entirely from the Security Exchange Commission's website, investor.gov, so really reliable information. Savings and investing for your future is a crucial aspect of personal finance. It involves setting aside money for future needs and goals and then putting that money to work by investing in various assets to grow your wealth over time. Savings investing can help you achieve various financial objectives, such as creating an emergency fund, buying a home, funding your children's education, and retiring comfortably. It's essential to start early and remain consistent with your saving and investing habits to maximize the benefits of compounding interest. There are various savings and investment options available. Some among are savings accounts, certificates of deposits, stocks, bonds, mutual funds, real estates, and more. Each option has its own risk and return profile, and it's essential to understand these factors before making investment decisions. Additionally, it's crucial to have a well thought out financial plan that aligns with your personal values, goals, risk tolerance, and investment timeline. Working with a financial advisor or utilizing online tools can help you develop a comprehensive plan and monitor your progress towards achieving your goals. Overall, saving and investing for your future can provide financial security and help you achieve your long-term financial objectives. Here's what we'll cover today. We'll talk a little bit about managing debt and making smart use of credit. Then we'll talk about strategies for saving and investing. We'll discuss some ideas on how to plan for retirement, including discussion of employer-based and individual retirement investment options. And finally, we'll go over tips to protect your money from fraudsters. Why do we save? What are some things that you're saving for or that you plan to save for? Do you want to own a home someday? Open a business? Start a family? Those are long-term savings goals. In addition to long-term plans, you also need an emergency fund to cover unexpected shocks like a major car repair, house repair, or health crisis. These things can require money in a hurry, and surveys have shown that many are unprepared to incur such an unexpected expense. As the name implies, savings are generally put into safe places that allow for easy access, such as a savings account with a bank or credit union. The Federal Reserve conducted a survey that showed that 4 in 10 Americans do not have enough money saved to cover an unexpected expense of only $400. That could be a minor car repair or cracked screen on your phone. Even a small financial shock can turn into a long-term debt if you don't have an emergency fund. Consider direct depositing a small amount of each paycheck into your savings account and take advantage of the special opportunities to pump up your savings like a tax refund or gift money. Try to work toward a goal of having a few months worth of living expenses saved in an emergency fund. It will make you less likely to go into debt if life throws you a curveball. You can't just put all your money into savings or stick it under the mattress because your money won't have the same purchasing power for what you'll need later. Prices for goods and services go up over time. It's called inflation. Recently, we've had a lot of that. Let's look at an illustration of an inflation. The cost of a Mustang GT two-door convertible in 1996 cost around $23,495. In 2021, it cost nearly $47,000. That's an increase of 99% in little over 25 years. That's the result of inflation. And inflation also impacts higher education costs, housing costs, foods, consumer goods, everything we need to live. So to keep up with inflation, you must make your money grow. And that's what we're here to talk about, investing. Savings is all the money you earn but do not spend. Investing is slightly different. It means making that money grow. The key difference between the two is that investing has risk, but it also has potential to earn higher returns. What does a bank pay you in interest to keep your money in a savings account? Less than 1% likely. There are now some better savings accounts and CD choices recently. I've seen some exceeding 5% APY. The money you have in a bank account may not grow much, but it will be safe since it's FDIC insured. So, why might we want to take on more risk? Why might we want to invest? How do investments keep up with inflation? It's through growing over time thanks to the power of compounding. Over time, that growth snowballs. Imagine that at 25 years old, you started investing $100 a month for the next 40 years. After 40 years, you would have invested $48,000, but thanks to the power of compounding, the money you invested might have grown to $239,562. In this case, a 7% annual return. That's about 5 times more than you contributed. By starting early and using the power of compounding, you're putting your money to work for you. That doesn't mean that the growth is consistent. This graph shows a benchmark of the stock market's performance known as the Dow Jones Industrial Average over the course of 30 years from 1990 to 2020. You can see that the index has had many ups and downs, but look at the long-term trend. Historically, the performance of stocks has trended positive. Keep in mind, short-term stock performances tend to be volatile, like they're jagged on the chart. But look at the long-term trend. Stock returns historically do well over time, on average 7 to 9% per year. But as you can see on the slide, the performance isn't smooth and consistent. Thanks to the power of compound growth, one of the best ways to build wealth is saving and investing over a long period of time. The earlier you start, the easier it is for your money to grow, which means it takes less money to reach your goals. Here's how much you need to save each month in your retirement goal if it was $250,000 or $500,000, depending on the age you started investing. Most of us don't think anything of automatic payments. With our monthly subscription and streaming services, we can apply this concept to saving and investing. It helps you to do your saving and investing automatically. You can set it up with your bank to have the money sent directly to savings or an investment account, such as a mutual fund account. In other words, set it and forget it. That creates the habit of saving and allows the power of compounding to work for you over time. This slide assumes a 7% average annual return, and of course, stock market returns can vary greatly from year to year. Now we will learn about savings and CDs. A savings account is a basic type of financial product that allows you to deposit your money and typically earns a modest amount of interest. These accounts are federally insured up to $250,000 per account owner and offer a safe place to put your money while earning interest. When determining the best savings account for your needs, there are several factors to consider. Here are some of the key factors you should evaluate. The interest rate is the primary factor to consider when choosing a savings account. A higher interest rate means you will earn more interest on your savings. So look for accounts that offer competitive rates. Fees. Some savings accounts charge fees such as monthly maintenance fees, overdraft fees, or transaction fees. Look for accounts with minimal fees and accounts that waive fees. if you meet certain conditions. Minimum balance requirements. Some savings accounts require minimum balance to earn interest or to avoid fees. If you can't maintain the minimum balance, you may incur fees or earn lower interest rate. Accessibility. Consider how easy you can access your money when you need it. Some accounts have restrictions on withdrawals and require a waiting period, while others offer more flexible access. Convenience. Look for accounts that are easy to manage with online or mobile banking features, ATM access, or other convenient features. Safety. Choose a savings account that is FDIC insured or NCUA insured so your money is protected in case of the institution fails. Customer service. Consider the quality of the customer service offered by the institution, as well as a reputation for customer satisfaction. Now, by evaluating these factors, you can find a savings account that offers the best of interest rates, fees, accessibility, convenience, safety, and customer service to meet your needs. Bank Certificate of Deposit, a CD. With a CD, you invest your money for a certain period of time, which can range from 1 month to several years. You receive interest when the term period is over or when the CD matures. But you may face a penalty if you need to withdraw your money sooner. Some banks may require a minimum deposit amount. Some tips. CDs may be a good choice if you want a FDIC insured investment and you won't need your money before the CD matures. Typically, the longer the CD period, the higher the interest rate. CD interest rates may be higher than those for savings or money accounts, but will still likely be lower than for other types of investments. Higher yield investments may carry greater risk, however. Laddering CDs is a strategy for investing CDs that helps you balance liquidity with higher interest rates. The basic idea is to purchase CDs with varying maturity dates so that some funds are available sooner while others continue to earn higher interest rates. Here is an example of how to ladder CDs over time. 1. Determine your investment amount, let's say $10,000 to invest in CDs. 2. Choose your CD terms. Decide on the terms of your CDs, including the amount you invest in each and the length of time until one matures. For example, you might decide to purchase 5 CDs with the following terms and amounts, as you can see in the chart above. $2,000 for 1-year CD, $2,000 for 2-year, $2,000 for 3-year, $2,000 for 4-year, and $2,000 for 5-year. Number 3, you purchase your CDs, invest in each CD with the corresponding terms and amounts. Number 4, as the CD matures, when the 1-year CD matures, you either withdraw the funds or reinvest in a 5-year CD, continuing the ladder. When the 2-year CD matures, you can withdraw the funds or reinvest them in a new 5-year CD, and so on. This laddering strategy allows you to access your funds as each CD matures while earning higher interest rates on longer-term investments. It can be a good way to balance liquidity and higher returns while minimizing the risk of investing all funds in a single CD with a long term. Now we will learn about investment products. Rule number 1 of investing is that all investments have what? Risk. But if you're a long-term investor in the U.S. markets, you have historically done well. In investing, the potential for higher return typically comes with higher risk. Different investments have different risks, and the potential for greater return generally comes with higher risk. Look how we move from safer but lower return cash at the bottom to higher riskier but higher return stocks. Stocks are shares of ownership in a company. Stocks have historically offered the greatest potential for returns. A stock can appreciate in price, and some stocks can pay dividends if the company distributes its earnings to stockholders. Stocks can lose value, however, and companies can even go bankrupt, leaving their stock worthless. Bonds are like IOUs. I lend money to a company or government body, and they promise to pay me back in a certain period. In the meantime, I can get predictable income stream from interest payments. Some of the benefits of bonds are they provide a predictable income stream. Typically, bonds pay interest twice a year. If the bonds are held to maturity, bondholders get the entire principal, so bonds are a way of preserving capital while investing. And bonds can help offset exposure to more volatile stock holdings. Some of the risks include interest rate changes can affect a bond's value. If bonds are held to maturity, the investor will receive the face value plus interest. If sold before maturity, the bond may be worth more or less than the face value. This is called interest rate risk. The bond issuer may pay the bond's face value before the bond's maturity date. This means that you would stop receiving the interest payments. This is something an issuer might do if interest rates decline. This is called call risk. The issuer may fail to timely make interest or principal payments and thus default on its bonds. This is called credit risk. Mutual funds and ETFs are a way to invest in stock market without purchasing individual securities. Many workplace retirement plans, like 401ks, offer a selection of mutual fund investments to employees. The main benefits of mutual funds and ETFs are professional management. The fund managers do research for you. They select the securities and monitor the performance. Diversification, or don't put all your eggs in one basket. Mutual funds typically invest in a range of companies and industries. This helps to lower your risk if one company fails. Affordability. Most mutual funds set a relatively low dollar amount for initial investments and subsequent purchases. Remember that all investments carry some level of risk, typically the same as the underlying securities. What stands out the most when you look at this chart? Lots of volatility, ups and downs. There are significant downs. The most prominent represents 1929 stock market crash, the Great Depression banking panic, World War II, the oil shock, dot-com crash, and the financial crisis Great Recession. It's mostly up. Despite inevitable down periods, the long-term trend of the market is positive. Historically, the longer the term average rate of return for the S&P 500 is 8 to 10%, somewhere between there. Therefore, if you have a long time horizon for your investments, you can capture the historical averages of the market by investing for the long term and ignoring the volatility and daily fluctuations. However, it's important to note it also demonstrates the shorter your time horizon on your investments, the more volatility becomes relevant. For example, if someone in 2006 planned to retire in the next few years but had all their investments in stocks, they would have been seriously hurt in the downturn in 2008 and likely would have been prevented from retiring at that time. This teaches us that as you get closer to your target date, like your retirement, it's important to shift your assets to reflect the changing risk tolerance. Increasingly shift portions of your portfolio away from stocks to less volatile assets such as bonds. In the chart earlier, we saw the risks of various investments. The best way to manage investment risk is to allocate your assets and diversify your investments. In other words, put your money in different asset classes, and within the different asset classes include different investments. Example, domestic, international, large cap, small cap stocks, so that if one investment performs poorly, another might do well. In short, don't put all your eggs in one basket. You've heard that, I'm sure, before. Asset allocation is deciding how to divide an investment portfolio among different assets such as stocks, bonds, and cash. Decide how to allocate your assets. You may want to consider your time horizon, how long until you need the money, and your risk tolerance. How much risk do you want to take? The longer you must invest before you'll need your money, the more risk you can afford to take on. Why do you think the sample 2050 portfolio contains mostly stocks? Because this sample portfolio is for a goal far in the future. It is more heavily invested in stocks, which are riskier than bonds and cash. That's because, like we discussed earlier, the longer your time horizon, the more risk you can generally afford to take. What do you think a 2025 portfolio might look like? Do you think it would have more stocks or less stocks? Why? The sample 2025 portfolio is more heavily invested in bonds and cash, which are less risky than stocks. The more conservative allocation helps to preserve the money because you'll need it sooner. You also should spread your money among different investments within asset classes. This is called diversification, and it means holding a mix of different stocks or bonds. One way to do it would be to hold stocks in a variety of industries such as consumer goods, healthcare, and technology. Diversification helps investors to manage risk because if one company or industry sector experiences a decline in value, others may post gains. The way funds diversify is by holding many different stocks, bonds, or other securities. Diversification helps investors because if one company or sector experiences a decline in values, others may go up. This graphic shows the S&P 500 stocks over a single day and is merely an example of holding that hypothetical fund tracking the S&P 500 index might have. For example, if industrial stocks in the lower right have a down day, perhaps gaining in your tech stocks, and financial stocks on the left will insulate your overall portfolio. That's the theory of diversification. Fees are very important and can impact your investment return. You should research and think about them before committing to any investment. There's a bulletin on investor.gov that shows the impact of various fees on a $100,000 portfolio over 20 years. What you earn after 20 years is shown on this chart, with the blue line showing a quarter-point annual fee, the red line in the middle showing a half-point fee, and the green line at the bottom showing a full-point fee. You can see the relatively small fee differences add up to tens of thousands of dollars over 20 years. For example, when you consider funds that are typically two types of funds, actively managed funds that rely on the skill of an investment professional to buy and sell securities, often in an attempt to perform better than the market, or index funds follow a more passive strategy that attempts to match the performance of a specific market index or benchmark like the S&P 500 or the Russell 2000 index rather than trying to beat it. Actively managed funds typically have higher fees so that you need to have a higher return to make up for the higher fees in order for you to make the same amount of money. And when you want to compare the fees and expenses of various funds, FINRA has a free tool, the Fund Analyzer, on its website, finra.org. It offers information and analysis on over 30,000 mutual funds, exchange-traded funds, that's ETFs, and money market funds, including the fees charged by the funds. Investing apps have become popular, especially with younger people. Many apps allow you to buy or sell securities or get investment advice. Some apps allow you to set an investment strategy, often based on your time horizon and risk tolerance. If you plan to use an investment app, make sure you're dealing with a registered investment firm. We'll talk about how you can do that in just a few minutes. When using investment apps, there are some things to be aware of. Some apps may give inexperienced users access to complex or high-risk products or strategies, like options trading, where you can lose more money than you invest. Some firms may be difficult to reach if you have questions. Some have no customer service phone support and only offer email assistance, which can take time for responses. Many apps advertise no fees or low fees, but check the fine print and make sure you're comfortable with how the firm is compensated. Keep in mind that some apps use entertaining user interface with notifications when stocks go up or down and fun graphic after transactions, and these can encourage overtrading or even encourage investors to treat investing more like gambling. If you plan to use an investing app, make sure you're dealing with a registered investment firm by doing a free background check on investor.gov. Now let's talk about saving and investing for retirement. First of all, the IRS provides tax incentives to save for retirement. Three common employer-sponsored retirement accounts are 401ks, 403bs, and 457bs. Private companies may offer 401k, while 403bs are typically offered by public schools and certain nonprofits and hospitals, and 457s are generally offered by state and local governments. With these employer retirement accounts, your contributions can be deducted from your paycheck. The IRS limits your annual contributions to an employer-based sponsored plan. Recently was at $19,500, an additional $6,500 for those over 50. But please check the IRS website for those rates for 2022 and 2023. Whether or not your employer offers a retirement savings plan, you can contribute to an IRA. If you do have an employer sponsored plan, there's the IRA tax advantage may be limited by your income. There are also income limits for Roth IRAs. Consult the IRS or tax professional for more information. Now, the limit for IRA contribution was $6,000 annually and additional for those over 50. But in the last couple of years, it has been increased. Check the website for IRS to know what it is currently. You may have the option as to which type of tax advantage you receive when you're with your retirement account. With a traditional option, tax break now, get a tax hit later, you'll lower your current year's taxable income by the amount of your contribution, and the money will grow tax-free until you begin taking distributions in your retirement. When you withdraw funds, you'll be taxed at the income rate at that time. With a Roth option, take a hit now and tax break later, you'll contribute after-tax money. In other words, you'll be taxed at the current tax rate, but then the funds will grow tax-free and have no future taxation. One strategy in retirement investing is choosing a target date or retirement date fund that automatically adjusts your mix of investments or asset allocation over a time from a more aggressive return-seeking strategy early on to a more conservative asset preservation strategy as you approach retirement. Target date funds are mutual funds that hold a mix of stocks, bonds, and other investments and are designed to be long-term investments for individuals with particular retirement dates in mind. The name of the fund often refers to its target date or retirement date. For example, you might see funds with the names like Portfolio 2030 or Retirement Fund 2050. Target date funds are often available through 401k plans, and some 401k plans may make these the default investment for participants. Consider the fees before selecting any funds, including target date funds. Here are some tips for saving for retirement. Start investing as soon as you can and let the power of compounding work for you. Consider increasing your contributions as your earnings increase. Max out your match from your employer if your employer matches your contributions, if you can afford to do so. It's free money and it's part of your compensation. Keep contributing whether the markets are up or down. Keep in mind that in down markets, the prices of the shares you're purchasing are lower, so your money is buying more shares. As the market recovers, the value of your portfolio increases as well. Always pay attention to fees, especially if you have a menu of fund choices in which you can invest your retirement contributions. Investments with higher costs must perform better than low-cost investments to generate the same returns. When you switch jobs, you may be able to keep your retirement account in the plan of your former employer, or you may consider transferring it to your new employer's retirement plan or rolling it into an IRA. Transfers and rollovers can be non-taxable events if completed within 60 days. Remember to pay attention to fees when you make those decisions. And if you're considering a lump sum distribution or withdrawal before age 59 and a half, be prepared to pay taxes and penalties on that money. Consider other alternatives. When you're investing, you need to take steps to avoid scam artists who will try to steal your money. A famous movie depicted financial investment fraud scam. You can search on YouTube for Wolf of Wall Street first sale and watch the clip and get some of the tactics that are used and journal on what you learned. Here are some red flags of fraud to keep your eye out for. Many scams sound too good to be true. Trust your instincts. If the offer promises high returns with little risks, it's probably a scam. Don't be pressured to buy now. No legitimate investment requires a quick action. Wait until you have time to do your own due diligence. Watch out when there's no prospectus, offering memorandum, or no statements or public filings. And make sure any investment professional you use is licensed or registered, and you can check that on investor.gov. Another red flag of fraud is an unsolicited offer to invest that come out of the blue. Consider why a stranger would need to pitch the investment to you if it's really such a good investment, and think about what the stranger's motives might really be. You should tread carefully when you didn't seek out the investment or the salesperson. Do your homework if you're tempted by the offer, or better yet, just walk away. The best scenario is when you do your own research and choose where to invest. Here are a few other things to remember so you don't get scammed. Never pay for investments with credit cards, gift cards, or wire transfers. Don't ever pay a fee in order to claim a winning or other proceeds. That's not how legitimate lotteries or investment opportunities work. If someone claims to be from the government and you did not initiate the contact, call the agency and find out if they work there. Be cautious when asked to share personal information such as passwords, credit card numbers, and account numbers. The first step to protecting your hard-earned money from investment scams is making sure you're dealing with a licensed/registered investment professional. Before you use an investment professional, including anyone selling you an investment, make sure you check them out on investor.gov. Typing their name into the Check Our Investment Professional box on the website will show whether they are licensed and registered. You can also see their employment history, including which firms they have worked for and how many years of experience they have, and if they seem to be jumping from firm to firm, which also can be a red flag. You'll also be able to see important disclosures. Let's learn more about what to check for and what disclosures include. Here's an illustration of what you would see when you click on Get the Full Report. In this example, see multiple disclosures. Disclosure events include certain criminal charges and convictions, formal investigations, and disciplinary actions initiated initiated by regulators, customer disputes and arbitrations, and financial disclosures such as bankruptcies. You'd also be able to see their registration history, which is a history of which firms they've worked for, including how long they worked for each firm. In addition to doing your due diligence on the investment professional, you can also research the particular investment you're considering. There's a tool on the SEC website called EDGAR that allows you to research publicly traded companies, mutual funds, and variable annuities. EDGAR is SEC's online database of corporate filings. If the company you're looking for is not on EDGAR, you may need to do more research because it may not be registered with the SEC. This doesn't mean that the investment is a scam, but it's good to keep in mind that a lot of scams involve unregistered companies, the ones you don't find on EDGAR. You can learn important information from the filings that these companies are required to make to the SEC, such as the company's registration statement, its periodic disclosures with the SEC, stock holdings of officers and directors, and the company's audited financials. Now, the main EDGAR page includes a tutorial on how to quickly research a company's operations and financial information. Just about everything that's been covered today in this presentation is derived from resources on investor.gov. And when you want to figure out how compound interest will work for you, that's one of the most popular tools on the website, Compound Interest Calculator, which allows investors to see how their money can grow over time. It lets you plug in the initial investment amount plus the amount you plan to contribute periodically. Then you can plug in the interest rate you expect to earn. Investor.gov has hundreds of timely investor alerts and bulletins on emerging risks to investors, fraudulent tactics, and investment topics. And you can see on this slide there's a few examples. You're more likely to act if you commit to acting now, so consider writing down what you intend to do because of what was covered during this training session. Take a few minutes now to answer these questions. What will I do? How will I do it? And will I share my plans with anyone if so? And that concludes the presentation for today. The next class will be exploring the various techniques and strategies that homeowners or renters can use to make their homes more energy efficient and save money on their energy bills. Thank you. Have a good day.